Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to help you make some money. My job is not just entertain, but do some serious explaining here. So call me 1-800-743-CNBC or tweet me at Jim Cramer. It's starting up again. You know the litany. The market's too concentrated. Gain just in a handful of stocks. The whole thing's a house of a cards. So sell, sell, sell. That was the story yesterday, and we heard it again this very morning, even as the averages opened lower and then rallied through the day. Dow ultimately slipping 25 points. S&P advanced 0.51%, but the Nasdaq ended up gaining 1.02%. Every time the experts start wringing their hands about concentration, the market's lack of breath, people sell the best stocks in the world. Look, I don't mean to cast aspersions on anyone who's trying to be prudent. There truly is a tremendous concentration of capital tied up in a handful of companies. But there's so much fear-mongering about this phenomenon that it's almost guaranteed to lead you in the wrong direction. 12 years ago, I helped coin the term called FANG, Facebook, Amazon, Netflix, Google, because these companies were changing the world. Their spectacular growth prospects made them incredible investments. Later on, I added Apple to make it FANG. Pretty soon, we had to throw in NVIDIA, Microsoft, too. You had to hold on to these for dear life. Their impact on our lives was palpable. And, of course, they're worth far more now than they were selling for 12 years ago. There was a concentration then. There's a concentration now. It's not fatal. It's lucrative. At the time, though, I took a lot of heat about my selection. People don't remember that. The FANG stocks were already up so much. Every single Jamoke and his brother knows these. I have a keen eye for the obvious. I didn't get my back slapped for coming up with something special. I was lambasted for pushing something pedestrian and potentially dangerous because they were all so expensive and concentrated. Ladies and gentlemen, we've now had more than 12 years of concentration. A dozen years. All along, it's been the same stocks. Netflix blossoming, one of the most respected, profitable entertainment companies of all time, maybe the most. Facebook became Meta. Why? Because of Instagram, because of WhatsApp, because of Reels, because of its dominance in advertising. Amazon's the largest retailer in the world. Its web division is doing amazing, phenomenal margins, amazing source of ad revenue, too. Now, though, let us talk about what really matters. What happened today? Google and Apple. That's what happened, because they are today's example of the dreaded, dangerous concentration. They are today's precipice. The two proverbial canaries singing their last in that darn coal mine. I get it. Believe me, I get it. I listened to the sirens and saw one of the canaries fighting for its life last year. The canary was Google. Now, Alphabet. After owning this stock for years, in 2024, I decided that its version of artificial intelligence, Gemini, was cannibalizing its regular search. The Donner Party. And more important, I was worried about the antitrust regulators going after them. Remember, big tech is one group that's hated by both Democrats and Republicans, both Biden and Trump. Sure enough, the Justice Department, in a suit brought during the Trump administration, succeeded in convincing a federal court judge, Amit Mehta, that's the first Trump, that last year, to make it so that they ruled that Alphabet violated Section 2 of the Sherman Antitrust Act. Alphabet Meta, the judge said, was a monopolist. You can't be a monopolist. It's illegal. I thought for a moment that this could be good news, that Alphabet could be broken into different pieces, and that would amount to more than the sum of its parts kind of thing, you know. Figured, wow, Waymo this and YouTube that. But the analysts and prosecutors told me that Alphabet would have to divest this thing called Chrome for nothing, maybe even have to pay to make Chrome independent. No breakup like Standard Oil, which violated the Sherman Antitrust Act, and then ended up with 34 separate oil companies that made you a killing. If you bought the children of Standard Oil, it ended up being one of the greatest wealth creators of all time. But we were told this wouldn't happen here, that Alphabet was in for some real punishment, that you'd get hurt. I had a huge gain in Alphabet for the Travel Trust. Now it was in jeopardy. It was supposed to be a death sentence for Alphabet, and I wasn't going to elect a chair with this one, so we sold it for the trust. In retrospect, I was a fool. The concentration argument, as I've said, was a total canard. A moronic Jeremiah ginned up by people who never owned a stock or aren't allowed to own a stock or think they know something, but they're a part of the know-nothing party. And the government, with its Kathy Bates goal of hobbling Alphabet, played by James Caan, did the sledgehammer cut it off at its ankles? Nope. You know what happened? The court yesterday basically took back last year's harsh ruling. It was a do-over. There's no monopoly here at all. Instead, there's Anthropic, DeepSeek, there's Meta, there's Microsoft, there's Open, there's AI, there's Perplexity, there's Grok, there's Donner, there's Blitzen. Competitors that have become so powerful that since the case was heard, that there's no harm here. In the end, I listened to the sirens of negativity and I left the stock, but nothing really happened. I want my money back. But the scaremongers aren't going to give it to me. The ones who worried about concentration. I left 50 points on the table. Was I a moron, a chowderhead, a mountebank, perhaps deserving endless opprobrium for what I did here? No. You see, fortunately, I didn't worry completely about concentration. I had a credo about Apple, the other A added to make our acronym sound like a tortured sheep. Fine. Own it, don't trade it, I said. I needed it because in the trial we learned that Google paid more than $20 billion to exclusively preload its search engines into Apple devices. The sages who mete out fear at every turn, they told you that Judge Mehta would end that payment. That's right, he'd violate it, that big, beautiful payment. President didn't trademark that, I'm okay. Apple's numbers would be cut the moment we got the ruling, we were told. More catastrophe for the gang that couldn't shoot AI straight. It turns out, though, it was just the opposite. Google still has to pay Apple for that deal. Otherwise, the ruling would just be a handout to an aspiring monopolist. The judge actually said that. You know what that means? I want you to listen to this. It means that Apple no longer needs to pay one of these hyperscalers money or buy a bot like a Perplexity for billions of dollars. Instead, all of these bot companies will now probably have to compete to pay Apple access to those more than $2 billion users. That's right. There isn't a clear winner right now in the chatbot space, but if you can pay Apple a fortune to make yours the default, someone's going to write that check. One of these companies is going to secure their Google-like status in AI, leaving behind a bunch of Bing who's spending billions for naught. Yesterday, Apple had no cards. Today, they have all cards. Turns out Apple always had an AI strategy, pay to play. You pay them, not they pay you. So who's it going to be? I think it's probably Gemini. Here's the bottom line. Alphabet stock rallied 9% today and hit a new high. Apple stock jumped almost 4%. I caught the ladder for the trust, but I missed the 9% Alphabet gain. Why did I miss it? Because of the dangerous concentration that all these really smart people told me was going to be dangerous. When it wasn't dangerous at all, it was just lucrative. Let's go to Jay in Connecticut. Jay.
Hey, hi, Jim. This is Jay. I'm a long time listener. And I appreciate. I've never called you yet. I want to.
Thank you, Jay. Thanks for calling. Let's go to work. What do we got?
You got a great sense of humor. You know what you're doing. Okay, this real fast. This is what happened. On April 7th, I got scared because the White House was talking about all the tariffs. I had 50 shares in Netflix, so I sold it. I made a very big profit. I had a long time, but people got into the habit. No matter what's happening in the economy, they love Netflix. So I'm wondering, here's the question. Should I buy the 50 shares back?
Okay, here's the issue. You did the right thing. Netflix went up a huge amount and you took a profit, and we should never feel bad about profits. We should only feel bad about losses. But if the question is, do I like Netflix, the stock? You bet I do. All right, there will always be stories that will sway you out of stocks, including things like, ooh, the gains are so concentrated, the winners are so small. But you end up selling the best because of that moronic stuff. And we got to stop it. Maybe we can stop it together. Well, Mad Money tonight. Was it a miracle on 34th Street or some disciplined management that helped Macy's report a blowout quarter? It wasn't the Fed. I'm checking with the retailer. Then I'm checking in with Martin Marietta's top brass following the company's capital markets day. It wasn't the Fed. And investors are looking for clarity on what to do with Salesforce. And man, so am I. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Oh, here's a great story. Look at this incredible move in the stock of Macy's, up over 20% today in wake of a tremendous quarter. Despite a tough environment for retail, this company, which also owns Bloomingdale's, Bluemercury, reported a stellar set of numbers this morning. Macy's posted a stunning 22-cent earnings beat off a 19-cent basis, higher than expected revenue, and the best same-store sales numbers in 12 quarters. Even better, management raised their full-year forecast for sales and earnings. So I've been saying there is a turnaround brewing here, and boy, did we get proof of it today. Don't take it from me, though. Let's go to Tony Springs, the chairman and CEO of Macy's. Get a better read of the situation. Mr. Springs, welcome back to Mad Money.
Jim, great to be with you.
All right, so Tony, we all knew. We all knew it had to happen. Their stores look too great. You're working too hard. It's obvious that you've come to the conclusion that, you know what, we're going to have only great stores and they're going to be exciting to people. What really made this all come together?
This was an across-the-board beat this quarter. So we had growth on a comparative basis at Macy's. We had growth at Bloomingdale's. We had growth at Bluemercury. Our inventories were under control. We delivered above our expectations on the top line and the bottom line. We saw growth in different categories depending on the families of business. So tailored clothing and mattresses and women's contemporary. So there was a broad-based category of interest. We did well digitally and physically. So as a multi-channel retailer, that also works. This was a really good quarter.
All right, so Tony, I think that there are people who are going to say how much of it is that the economy is not as bad as we thought, how much of it is that the tariffs didn't hurt that much, how much of it is just real hard, roll your sleeves up work to make it so the stores all look great. Because you know where I am. I'm on the latter, but I have to let these people who don't shop it where you shop and where we shop, we got to give them some macro nonsense. So hit me with that stuff.
There's certainly a resilient consumer out there. Yes, you're absolutely right, Jim. We have to work hard and we have to stay focused on delivering for the customer every single day. Don't take anything for granted. We have to earn their wallet. We have to earn their interest in our brands. But I think when you look at it, the consumer is saying, I want newness. I want fashion. I want value. And I think where we had newness, where we had fashion, where we had good value, we had good business. And I think that's a good recipe as we move through the remainder of the year. The consumer is going to be choiceful. The reality of tariffs are there. That's the headwinds. That's what's happening around us. But we get to control our marketing, our merchandising, the variety we offer, how we take care of the customer. That's all up to us.
All right, so Tony, where are we in terms of finally being done the closings? Because I think you can grow and put these numbers up. And we're going to be talking about Macy's for a very long time as one of the most exciting turnarounds in retail history.
I love the spirit. We closed 64 stores last year at Macy's. We closed a Bloomingdale store. We will have more closures again this year. You know, when we launched the Bold New Chapter about 18 months ago, we talked about closing approximately 150 Macy's stores. You know I love stores, Jim. I started in stores. They have to be the right stores. They can't be in malls that are past their prime. They can't be where the customer has moved to another shopping center. So we had to reshape the Macy's portfolio. That is underway. We're in the middle of that process. But also with a healthy balance sheet, I am not going to fire sale stores. So as long as we're making money, as long as we have positive cash flow, we're going to continue to operate those stores. When there's good opportunity to monetize those stores, that's what we'll do. Conversely, we're going to continue to open more Bloomie's outlets and Bluemercury stores because there is opportunity for us to grow both of those businesses as well.
People are buzzing about this point system at Bloomie's, where sometimes you get so many points, you come in and you just get a free dress. What is going on? This is something I want to know more about.
They have a great loyalty program. The Loyalist program at Bloomingdale's, like the Star Rewards program at Macy's, is designed to get you, like the airline programs, to devote yourself to one multi-category retailer so you buy more and more from that retailer, and then you earn free product. And you're absolutely right. If you buy a wonderful bracelet at Bloomingdale's, you may be able to get the earrings for free. That opportunity is a part of how we've devised the program so that you don't buy your jewelry from one store and you buy your cosmetics from another store and you buy your furniture from another store. We want to lean on the fact that we can be your one-stop shop experience, not because we have each of the categories, but we have what you're looking for in each of the categories, and we take care of you properly in each of those areas.
Well, let's do the talk to take care of you. Did you hire more people at your Blooming store? I just find the customer service at the stores I go to. No, I'm not kidding. There's different customer service versus the other department stores where I can't find anybody.
We're raising our game. And, as a part of the Macy's Reimagine 125, we absolutely added staffing into the stores. We added people into the fitting rooms. We added visual talent. We made sure that we had enough people in the contemporary area, in the men's tailored clothing area, in the jewelry area. So people can't purchase themselves. They need help in many of these areas. And I think this is an important part of making sure that we don't try to outbe convenience, the stores that are great at convenience, or be better than the people that are great at value. We have to be great at what we do, which is variety, value, and experience. And I think if we do those things well, we're going to earn the business from the customer. I like the fact that we go off-price to luxury. We capture 40 million active customers across the 3 brands. It's a good representation of the American consumer. And I think back to the research we've done, when we take care of the customer, we get the business.
Yeah, it's funny. When I read the release, the first thing I said was, oh, my God, inventory's not a problem. I'm not going to hear promotional Christmas. I am not going to hear vicious competition. Your inventories and your balance sheet have set you up for a good holiday, I think, no matter what.
I agree. I'm a biggie on, like you, fiscal discipline on the inventory, but it's also composition, not just quantity. And I feel really good about the composition of our inventory. We have more newness. We have more wear now product. We don't have a lag or a jag of inventory that we're carrying into the fall season. So that's really good work on the part of our merchants and our planning team. I also think it's leveraging the fact that we have marketplace where we don't carry the inventory, or we have lease and consignment businesses where we're not carrying the inventory. Those are other ways that we can be more in stock and offer the variety without putting all the risk on our balance sheet. And you're right, the balance sheet is in very good shape. We extended our debt maturities to 2030. We have runway. We're buying back stock where appropriate. We're investing in the business. So these are opportunities for Macy's, Bloomingdale's, and Bluemercury to shine.
Are we ever going to get to, and this is, of course, more anecdotal than I like to do, but when you got out of college, your goal was to get a Macy's credit card because that's how you establish credit. Is there any way that the Gen Z guys, people will understand that this is the way it used to be and they can do it again?
I think we're seeing multi-generational credit card openers right now. We're talking to our partners on American Express, and they see the millennial and Gen Z interested in credit cards. To your point on point programs, the opportunity to gamify, to add value through other ways is what is now attractive to a loyalty program or credit card program, not just the ability to have credit. So I think it's up to us to make sure that we're adding enough value into our program. That could be the free delivery, a better return policy, could be added points, could be free gifts. That's the way you get someone excited about participating in your credit program. And by the way, we had a good credit card performance in the second quarter and forecasting nice improvement for the year as well.
Well, that's right. Man, I saw that. I said, oh, my God, it could be like the old days where it's just this kind of gravy. Well, look, Tony Spring, a remarkable job. Fantastic work. So glad to have you on the show.
Thank you, Jim. Great to be with you.
Absolutely. It's Tony Spring of Macy's. It's not done going up. It's hard for a stock to go up more than 20% in one day, though, without a takeover. Mad Money's back after the break.
Coming up, is this stock constructing a profit? Cramer's one-on-one with building material manufacturer Martin Marietta and seeing if now's the time to get bullish on the building sector. Next.
Okay, what's going on with the stock of Martin Marietta Materials, which supplies building materials like aggregates, cement, ready-mix concrete, asphalt? Over the past few years, this company's been a big beneficiary of federal infrastructure spending, and there's still a lot of money left in Biden's old infrastructure package. I had no idea until I read his deck. They had a big analyst meeting today. The last quarter was solid, too, and the stock's up a quick 38% from its April lows. Today, Martin Marietta hosted a capital markets day in New York City to make their pitch for the business going forward. So what did we learn? Let's take a close look with old friend of the show, Ward Nye, Chairman, President, and CEO of Martin Marietta Materials, to learn more. Mr. Nye, welcome back to Mad Money.
Jim, it's great to be here. Thank you.
It's very clear from your Analyst Day presentation that there are many, many levers that you have to do even better than you're doing now, and you are doing sensationally.
Well, thank you. The company has done really well, and part of that's team, because if you don't have the right team, it doesn't work. Geography is really important, and we've nailed that, I believe. And we also have culture. But if you're looking at the end uses, infrastructure is strong. Right. It's going to continue to be strong. As you said, right. IIJA still has 40% of the dollars that have yet to go in. The states in which we're located have DOT budgets that are up 2x normally what we see in the other 40 states across the country. And now we're starting to see things happen in the private sector. Data centers are really starting to roll out. Warehousing that was great 2 and 3 years ago is seeing some real green shoots today. All of these are incredibly aggregates intensive, and we're in the right locations to help push that along.
Now, I think that the first thing people think is like, wait a second, no one's building houses. There's not a lot of public plan unit developments. But it turns out that you're so diversified that even though housing hasn't necessarily come roaring back, it doesn't seem to matter anymore to the earnings per share.
It really hasn't. And if you're looking at EPS over the relevant time frame, it's up notably. So again, what we're seeing is very good commercial activity in our space. We've seen value over volume, I think, to your point. And what we're seeing is cash gross profit per ton grow in ways in our business that are very different than others in our sector. And we expect that to persist.
Now, I think people are going to say, wait a second, how is it possible that federal money hasn't been spent? But it's not that easy to spend that money that quickly, right?
Well, it's not that easy to spend it. And you have to keep in mind, this one was more money over more time. The DOTs at the state level hadn't had a chance to add capacity in a long time. It's not that difficult if you're just repaving asphalt on old asphalt. But in these southeastern, southwestern states where populations have come in very dramatically, they need to add new lanes. They need to build new highways. That's what takes a bit longer. That's why we've seen this roll out a little bit more slowly than some might have expected.
But you did give a case study about North Georgia. I know we could do California. I just like the North Georgia because it's something I didn't know was doing well, where you guys are crushing it.
We are.
I like that. There's a little rock joke there.
But you're right. If you go back and look in North Georgia a decade plus ago, we had 2 operations there. We have grown very purposefully, very systematically there because Atlanta continues to grow out. It continues to grow north. And if you look at the 285 perimeter that goes around Atlanta, that's really your growth corridor. And you have so many small dynamic markets there that continue to grow and are showing no signs of slowing down. And being in a position that we can be 1 or 2 in a market like Atlanta has long driven our strategy. And that's an important place for us. It's a good place to look at and start.
Okay, so talk to me about the nature of the business. And the reason I say that is I'm writing this book. And one of the things I discovered was the best performing stock over the last 100 years is Vulcan Materials, your competitor. I mean, is it just a great business to be in? I mean, I don't know how much better they are than you.
It's a great business to be in. We just haven't been around for 100 years, Jim. That's the difference. No, they're a superb business. I think we're a superb business as well. 2 American iconic brands. But if you think about it, what we're doing at the end of the day, Jim, we're building communities. And that's what's important for us. And we're being good stewards of what we're doing in communities. So if we're in a place that we can help Atlanta grow, but in the fullness of time, keep in mind, we own 170,000 acres across the United States in big MSAs. We're going to be there for MSAs as they're growing now. But in the fullness of time, we can provide water reservoirs. We can provide giga plants that are going into these locations, new sites for residential and non-residential activity. These are very, very good businesses, and people spend a lot of time trying to poke holes in them.
Now, one last question. I have to believe that when you build the kind of data center that people are talking about, that is just a gigantic job. I don't know if it's as big as an airport. I'm as big as an interstate, but the size of these things is just monstrous.
They're enormous. I mean, here's the way to think of it. Years ago, when we were looking at non-residential projects, say a big box commercial store, these are 7, 8, 9, 10 times more aggregates intensive than those would have been. So if you're looking at warehousing, that's intensive too. These data warehousing will be incredibly intensive, and the power generation that's going to be required for them and the stone that will go into power is going to be the next shoe that you will see continue down this very exciting path.
Well, I think people have to understand that that has nothing to do with the Fed.
No.
I mean, people might be thinking, I can't be in this because who knows, is the Fed going to cut or not? You're talking about end markets that really aren't determined by Jay Powell.
That very much stand on their own, and they see significant holes. If we're looking at Texas today, which is our largest state by revenue, they've looked at incredible power generation needs they're going to need between now and 2030. And that's the time frame that we just spoke to our groups today on Capital Markets Day. What do we look like for SOAR 2030? And if we're looking at residential, which we think is going to get some steam as rates come down, infrastructure, which will be very good throughout that period, and you're seeing non-residential, particularly in this heavy piece of it, performing well now with a lot of track ahead.
Well, look, it's just been a great situation for so long, and you and your team have done a remarkable job. It remains just a fantastic stock to own. Ward Nye is the chairman, president, and CEO of Martin Marietta Materials. Everything's in there, what we call a deck. It's all very self-explanatory. Thank you, Ward.
Thank you, Jim.
Mad Money's back after the break.
Coming up, fresh off its latest earnings report, Cramer's catching up with Salesforce and seeing how the company is evolving alongside the AI revolution. Next.
do we make of this quarter from Salesforce? The stock dropped after earnings thanks to some concern over guidance. But are we nitpicking? After the close, we got a chance to check in with Mark Benioff, the co-founder, chairman, CEO of Salesforce, to attempt to figure out what's going on both with the stock and the company. Take a look. Mark, welcome back to Bad Buddy.
Jim, it's great to be with you. Thanks for having me, always.
All right, so let's puzzle through here. I want to do a different kind of interview with Salesforce. I can sit here and say, you know what, you grew 11 on this and 10 on that. Or I can ask you, a year from now, are we going to see every company be doing what a Williams-Sonoma is doing or a Reddit is doing? Because if we're just going to pigeonhole you to this high single digit, low double digit, that may be missing the forest through the trees.
Well, the absolute number, Jim, is some of the biggest in the software industry. $10.25 billion in revenue for the quarter, up 10% year over year. Jim, it's incredible. $15 billion of cash flow for the year. It's incredible. So before we start getting pigeonholed, yes, let's get pigeonholed on that. $10 billion in revenue for the quarter and $15 billion for the cash flow for the year.
But people are going to tell you
right, Jim, we are
operation
going
cash
through,
flow was supposed to be $935 million. It came in at $740 million.
Oh, Jim, we're raising our cash flow for the year. Okay. It's incredible what's happening for the company. And Jim, you are right, though, at the macro level. We are seeing an incredible transformation of every enterprise into becoming an agentic enterprise. The idea that software is becoming apps and agents working together to make customers more successful is something that we're seeing in every business, but it's really started in our own business. And we've been talking about that for about 9 months now with you, that you can see that on help.salesforce.com has now completed about 1.5 million conversations between our agents and our customers. And at the same time, our customer support agents, we have thousands of them. Well, they also completed about 1.5 million customer service conversations. And yet the CSAT scores were about the same. So now we can really see, especially through this kind of orchestration, that it's humans and agents working together to solving these customers' needs. And Jim, we're about to move from doing that just on support, which has been awesome. And the second stage of the agentic enterprise is sales. So, of course, that's our namesake product. But now, Jim, we have our new sales agents. And our sales agents are out there calling prospects, closing deals, generating appointments for us and our customers. And why that's exciting, Jim, is you just think about for Salesforce. In the last 26 years, we've had more than 100 million customers, we'll call it 20 to 100 million customers, who have contacted us. We haven't been able to call them back. We just haven't had the people. So now we can call all of those customers back through our sales agents. It's an incredible new capability for Salesforce, for technology, and our pipelines have never been richer and fuller because of that.
Then how is it
so
possible
that's a very exciting
that
idea that we're now agentifying sales.
Shaded down your estimates for growth. If that's the case, that's what I'm trying to get my handle on. Like
Jim, we're not. We've raised our guidance for the year. We've raised our margins for the year, and we've raised our cash flow for the year. In all cases.
Okay, against estimates that I'm talking about, not against you. But I mean, for instance, the current remaining performance obligation, $1.61. I was looking for $1.81. Again, this is what I don't want to get trapped in. I think these things are the forest. And
our Q2 viewers, CRPO is up 11% year over year.
Yes, it was, but then you took it back down to 9. You beat your estimates dramatically. And then you took the estimates back down again. I think that people have to get away from this. They need to be thinking, what is Williams-Sonoma doing? Or what is Reddit doing?
Jim, you can see our results are absolutely fantastic. And our guidance is also, is always appropriately conservative. You know that.
Yeah, it is. Well, what I'm trying to get people to understand is that your other businesses, which everyone told me weren't doing well, completely wrong. They're doing much better than people thought. And this business, the AI business, is actually going to be doing $1 billion in sales. And people have to get on board.
Oh, it's over that already.
Well, I'm just saying that.
Well, the AI business is already over $1 billion. It's our fastest growing business ever.
I know.
And by the way, that's the catalyst, Jim, for the agentic enterprise. The agentic enterprise is happening for every customer. You saw it in Williams-Sonoma. You see it in Reddit. You see it in every single one of our customers in the quarter, thousands of transactions that we completed. Even multi-million-dollar transactions grew, at rates that we haven't seen in a long time because every customer realizes that what Salesforce is doing, they can do for themselves. I kind of showed you how we've dramatically reshaped our customer support. We've lowered our costs by like 17% this year because we were able to bring in agents. And now we're doing it with sales as well. Jim, here's another way to think about it. We do 11 million emails a year with our customers, 11 trillion emails a year with our customers, trillion with a T. And each one of those has been a one-way conversation. But now we're showing how there's going to be an agent at the end of every single one of those emails, so they're all two-way conversations. Or our field service product, which is one of our fastest growing products in the quarter, field service is now fully agentic. So when that Eaton sales rep comes and works on my, power device that connects my Airstream trailer, to my house, which is actually something that I have, before they're just working on the system of record. Now they have the system of record and the agentic system working together. That's what's so exciting about what's happening. Every single one of our products is getting fully agentified, including Slack, which also is why it had such a great quarter. And you can see it in the revenue. Up 10% year over year on the revenue, $10.25 billion. Subscription and support revenue, Jim, was up 11% year over year, $9.7 billion. Jim, what software company are you covering that is up 10% to $10.25 billion this year?
It's not the number. It's
on the
guide.
quarter.
Look, I thought the number was terrific, Mark. It's revenue
okay, so are we just talking about Are you just talking about our CRPO guide?
The 8.59% year over year and 8% in constant
currency. Well, Jim,
currency.
I guided that for last quarter too, but you can see I beat it.
Well, look. My channel trust owns it. I'm not out to drive the darn thing down. I'm trying to explain why it's down where it is. And
what are we talking about? Our results or our guidance?
It's maybe at 22 times earnings. This
what
kind of guidance is good.
What are we talking about? Our results or our guidance? I don't know what we're talking about.
The results were terrific, Mark.
You're upset about the guidance?
Well, no, I'm not upset about anything. I think that this is the future.
Oh, good.
I think that when someone like Laura Albert from Williams-Sonoma, whom I regard as a genius, or Steve Huffman at Reddit, who I think is one of the smartest executives in the world, have turned over so much of their growth to you, that's what's going to happen in the future, and that's what I care about.
Well, the most exciting thing, Jim, that I see is that here's Salesforce. We're obviously going to deliver just a phenomenal year this year. You can see the top-level numbers that we're guiding. But the idea is not just in the numbers. We've completely transformed our product line, and you can see it in the way we're operating our business. We've completely reshaped our business as well. We've changed, we've reduced the number of heads we have in service and support because we have supplemented that with agents. We're transforming how we're shaping sales. We've added more salespeople than ever before because our pipelines are bigger than ever before because we have agentic sales. And even in Salesforce internally, we have dozens of agents. I think you've seen like how Slack now has these agents where I can renew, in a deal or close a deal or even check on my employee benefits, all through Slack. So that is what's so exciting. And so if you're going to fix this only on our guidance point for next quarter on CRPO, which is a number that we beat this, in actuals for this quarter, gee, I need to go back and look at my guidance. Maybe I'm just being, too conservative. But I think I am being appropriately conservative, but I've always been that way for 26 years.
I know you have, and I think it's a right to be appropriately conservative. It's just that at a certain point, there's a delta where it comes out that you can't even control how much business you're doing because this thing is such a better product than everybody else. I've been waiting for that, and I'm patient. Because that has to happen. You're going to get a moment where people realize, wait a second, Williams-Sonoma's crushing it. I want to crush it. And that's happening. And I think it's happening, and maybe it will be on display at Dreamforce.
Jim, there's been so much disappointment with generative AI, but not at Salesforce customers. We're not just delivering repackaged ChatGPT, at some productivity level to our customers. We're delivering them very high quality artificial intelligence that's giving them the ability to fundamentally transform their business. That is what's truly incredible. And in every customer we have, we're mapping out how they can become an agentic enterprise. And we are the template. We're customer zero. And we're showing it this is really working. This is incredible what is happening. And it's showing up right here in the revenue, profit, and cash flow numbers. Look, Jim, how many enterprise software companies, I hate to say it, are delivering $15 billion in positive cash flow this quarter? You know the numbers.
No.
That is what's really amazing. And when whether it's the cash flow, the revenue, the profit, and the customer success are all woven together. So if we're only zeroing in on, well, you're saying your CRPO number for the next quarter is going to be this. What's that about? I think we're missing the forest from the trees.
I agree.
The reality
I don't want to nitpick. Nitpickers lose. Nitpickers lose. I think what you're doing is remarkable. I think the fact that you were able to move 4,000 people. Listen to the webcast. You're doing a lot of.
Jim, Agent Force and Data Cloud, which is the heart of our AI strategy, is up 120% year over year.
Amen.
That is the transformational elephant for the whole fundamental business.
I think that it's,
and that is what's really amazing. And then you see these huge deals that closed in the quarter, including the U.S. Army. Where we beat Palantir. It was incredible. Where we have this incredible new Mission Force initiative in our company.
Well, let's go
We're
over
really
what
saying to the government. And by the way,
I want to know what happened with the Army contract. You beat, what you say, you beat Palantir?
You need to remember something, Jim.
Okay.
Our government business, the U.S. government, is our largest customer, right? It's a multi-billion-dollar customer for Salesforce. And if we run the Veterans Administrations and the GSA and all these great civilian agencies, but Jim, that there's certain areas that we haven't exactly gone into, and we're not going to go into the details of that we've left that for others. And, but there are areas in the DoD that we are currently selling to. We want to sell to more of those. And one of them that we did in the U.S. Army this quarter, we had a tremendous success against Palantir because, by the way, our prices are just so much lower. I mean, their prices are just so extraordinary. Their cost of Palantir, I'm sure you've seen the price list.
Yes.
It's incredible. But look, we're offering a very competitive product, at a much lower cost.
All right, well, look, let's do this. Let's just have people understand the future, which you're not going to be doing 12, 13% next quarter, but you beat what you said when you were on last time. Everyone got down, because you said you're down to like 8, 9, and then you do 11. I rejoice at 11. I'm not going to think I don't care, because if you did the same thing again, we're going to have the stock at an 18 multiple, and it's going to be the fastest growing 18 times earnings stock I've ever seen.
Listen, Jim, I've been a $4 million company, a $40 million company, a $400 million company, a $4 billion company like a Palantir, but we're a $41 billion company, 10 times larger than a Palantir.
And
you can't all of a sudden throw around these growth rates and say a $4 billion company should be growing it and the $40 billion company should be growing at the same rates. It's not the way to look at business. We're delivering very high levels of customer success, very high levels of quality financials, the cash flow, the margin, the GAAP performance, the non-GAAP performance that all of our investors want and that we want.
I agree with you.
Is the high quality outcome. And at the end of the day, all of those customers are becoming agentic enterprises, transforming themselves to deliver new levels of profitability, customer success, through artificial intelligence.
I think that's the right brief.
That's what's really exciting.
That's the right brief. Unfortunately, we have to make it a brief, but that's the right brief. Mark Benioff, co-founder, chair, and CEO of Salesforce. Guys, there is great growth here. Stop looking at the stock. Start thinking about the business. Thank you, Mark.
Jim, going to see you at Dreamforce October 14th.
Thank you.
It's going to be amazing.
Can't wait. Thank you.
Looking forward to seeing you.
Man Money's back in for the break. It is time. So the lightning round comes back. And the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Chris Start with Mike in Connecticut. Mike.
Hey, Jim. Hey, I just wanted to congratulate you and staff for what you do. I think it's wonderful.
Oh, thank you, buddy. Thank you. It's out of control right now, but yeah, I appreciate it.
Okay. Hey, that being said, I think I made a boo-boo. What do I do with CHYM?
You sell that and buy a firm. There you go. Let's go to John in Florida, please. John.
Booyah, Jim.
Booyah, John.
Hey, man, I was one of your first callers, and I remember watching you at 6 and 11. And I need your wisdom.
Don't forget the 9. They took the 9 from me and broke my heart.
I need your wisdom on PJT Partners.
We don't really know what they own inside. It's like some sort of it's a service thing that I don't really understand. Just buy Goldman Sachs. Let's go to Greg in Tennessee, please. Greg.
Good day, Mr. Cramer. It's a pleasure to talk to you.
Oh, how are you doing?
Very well, thanks. My question is about Eaton Corporation. I'm inclined to add to my...
I think you should. Now, my Travel Trust owns it. We talk about it a lot. We think it is just a terrific stock, and club members know we like it. By the way, I think Vertiv's a good company, too. I just am not recommending that one right now. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
Heard it yesterday, used it today, kind of liked it. I told Carl in the morning show that we are in a K economy. That's where the top right prong is going higher, the bottom right prong is going lower. It's a metaphor for the U.S. economy, where the rich are rolling in it while everybody else is riding the chute into oblivion. We're constantly told this is happening. Today, we got a survey from PwC, big consulting company, showing that holiday spending will be down 5%, the biggest drop-off since pandemic. Gen Z could reduce their holiday spending by 23%. The rich will be spending as usual. In fact, with the huge reduction in federal taxes coming, maybe it could be an amazing Christmas for the 1%. To which I say, here we go again, doomsaying from 40,000 feet. Who the heck knows what total holiday spending will look like right now? And who the heck knows if we're actually really in a K economy? I do think something's going on with the consumer that has nothing to do with Special K. It has everything to do with the pandemic. Remember that? Specifically the comeback from the pandemic, which changed so many spending patterns, people's lives. The American people at the top of the K are long on money but short on time. They need to get away and see things before it's too late. That's why the hotel stocks, airline stocks keep running. Lower part of the K, well, it's spending too, just not as much. Cruise lines, domestic travel, Yellowstone, Yosemite, Cascades, Crater Lake. Now, the rich have enough money to do more than one thing. They can keep spending on expensive stuff, the boats, the second homes, maybe rehab, which is the real K economy. The lower rung, spending differently. Trying to go fine dining, they ended up going to Chili's, that's owned by Brinker, at Darden's Olive Garden. They like the bargains from TJX, nice store. They shop at Macy's, they like what they see now. Believe me, Macy's couldn't put up such great numbers in a real K economy. They aren't falling off the safety net, they just aren't shopping where you can find them. And they're more value conscious than they should be. Hey, that's smart. Are the two prongs going to reverse? Will the lower one turn up? That depends on the job market. Hard to really head down if we have jobs. And that's why I think the K economy metaphor may be too darn negative. I'm thinking more like an E economy. Upper, middle, and lower segments staying in place, perhaps because so much consumer spending does seem frozen. People are sick of higher prices. They don't want another round of inflation. Top rung wants the best sneakers, the middle sneakers, and the bottom sneakers. We're a running in place economy. Until something happens, lower rates, a court ruling in favor of the tariffs so we can stop talking about them anymore, cessation of inflation, maybe a collapse in oil, nothing's really going to change. So as quickly as I rallied around the K economy, I want to retire it. The bottom rung is still spending. They just aren't profligate because that's a loser strategy. We've learned that. Is there a greater takeaway? How about this? Companies are making fortunes, including most retailers, and the economy is easier for them than you think. And it can change for the better at any moment. I think it will. I like to say there's always a bull market somewhere. I promise I'll try to find it just for you right here at Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.